All right, let's talk about the Great Reshoring. It's one of the biggest and potentially one of the most profitable economic shifts happening in our lifetime. For decades, the entire global economy ran on this one simple rule. But that rule, it's broken. The foundation is cracking, and something totally new is being built to replace it. We're going to break down the end of that old era and the beginning of the next one. So let's dive in.
For the last 3 decades, pretty much everything ran on one simple, powerful idea. Make things wherever it's cheapest, and then sell them everywhere else. It created a ton of wealth for sure, but that engine has completely stalled out. And now a new reality is taking its place, one where deglobalization doesn't actually mean the end of trade, it just means the end of long-distance trade. Today, we're going to get into why that old model broke, what's replacing it, and maybe most importantly, what all this means for you as an investor trying to get ahead of the curve.
Okay, so to really get a handle on where we're headed, we first have to understand where we've been. So let's jump into that golden era of globalization, that 30-year boom built on what was really an unprecedented economic miracle. The scale of this shift is it's staggering. Around 1990, when China and Eastern Europe opened up to the global economy, it meant a nearly 120% increase in the available workforce for advanced economies. I mean, just let that sink in for a second. The labor pool for Western companies more than doubled, almost overnight. All of a sudden, there was this massive, accessible, and incredibly cheap pool of labor just ready to go. And that massive labor pool, well, it created this almost laughably simple and wildly profitable formula for big companies. Offshoring. Why would you pay a premium for labor at home when you could build a factory thousands of miles away for a tiny fraction of the cost? It became the standard playbook for pretty much every global business. But as we're about to see, the end of that offshoring era is giving rise to a completely new strategy, nearshoring. And look, this model created the world we all got used to, right? For us as consumers, it meant cheaper TVs, cheaper phones, cheaper clothes, cheaper everything. For corporations, it was a golden age of just unbelievable profits and expanding margins. And for the global economy, it created these super efficient, just-in-time supply chains that delivered everything with what seemed like perfect, clockwork precision. This was just normal. But as it turns out, that whole finely tuned global machine, it was basically a house of cards. A whole series of shocks came, one right after the other, and completely fractured the system, revealing these huge hidden risks of a world built on offshoring. Yeah, it was a rapid 1-2-3 punch. First, in 2018, the US-China trade war started throwing sand in the gears with all these tariffs and protectionist policies. Then, bam, 2020. The pandemic brings the entire world to a screeching halt. All of a sudden, one container ship gets stuck in a canal and suddenly there are shortages on the other side of the planet. And then, on top of all that, geopolitical conflicts flared up, weaponizing things like energy and commodities. So here's the big takeaway. This wasn't just some temporary glitch in the system. As the source material puts it, it was a meaningful shock to the global supply chain. The fundamental idea that stuff, money, and people could flow freely and cheaply across any border, that idea was shattered. The risk of having your entire business depend on a factory halfway around the world became painfully and very expensively obvious. But here's the thing, and this is the part that so many people miss. Even if the trade wars and the pandemic never happened, this model was already living on borrowed time. There's a much deeper demographic time bomb ticking away. Remember that huge pool of cheap labor that powered globalization for 30 years? Well, it's getting older, and it's shrinking. That demographic tailwind has turned into a headwind. The simple math that made offshoring a total no-brainer just doesn't add up anymore. So if cheap, abundant human labor isn't the engine of the global economy anymore, what is? Well, the answer is this new, incredibly powerful force that's driving a completely different kind of industrial revolution: artificial intelligence and automation. The old model was all about chasing cheap labor around the globe. The new model? It's about replacing expensive and now scarce labor with intelligent machines at home. This is the great substitution, and it's what makes this whole great reshoring idea actually possible. Advanced automation and AI are starting to level the playing field, making it economically smart to build complex things in high-wage countries again. Now, if you want to get a sense of just how massive the physical scale of this new AI-powered world is, get a load of this. This is not science fiction. This quote shows the absolutely insane demand for energy that the AI revolution is creating.
We're talking about a physical build-out so huge that tech companies, not energy companies, but tech companies, are thinking about running their own nuclear power plants just to keep their data centers online. Wow. And this is where the real opportunity lies for investors. Forget trying to pick the one winning AI company. Think about the picks and shovels instead. You know, back in the gold rush, the people who made the most reliable money were the ones selling the picks, shovels, and jeans to all the miners. It's the same exact idea today. The real, tangible investments are in the physical stuff that makes AI work. The companies upgrading our power grids, the ones making those specialized liquid cooling systems, the fiber optics, and of course the advanced computer chips themselves. Now, this new world doesn't mean you just forget about investing overseas. Not at all. But it does mean the old maps are pretty much useless. In this fragmented world, you need a totally different approach. You have to find the new corridors of trade, what some people are calling nearshoring 2.0. So how do you even begin to find these new hotspots? Well, you can go top down, looking at big picture, country-level trends. Or you can go bottom up, which means you basically ignore the country's label and instead screen thousands of individual companies all over the world looking for hidden gems. This bottom-up approach, using things like foreign direct investment data, is how you can spot the lead steer companies moving into new regions before the rest of the market even has a clue. And when you start digging with that bottom-up approach, you see this whole new map taking shape, the rise of what you could call secondary hubs. It's not just about companies leaving China, it's about where they're going next. You see this in places like Vietnam, which is a huge part of that China plus one strategy, but you also see it in places like Mexico and Poland, which are quickly becoming manufacturing powerhouses for the US and the EU respectively. These are the new trade corridors, built on being close, not just being cheap. But, and this is a huge but, you have to go into these markets with your eyes wide open. There are some unique risks. In China, for example, a lot of the big tech stocks use something called a variable interest entity, or a VIE structure. Let's be super clear about what that means. You're not actually buying a share of the real company. You're buying a share in a shell company that just has a contractual right to the profits. If that contract ever gets challenged by the government, your investment could literally go to zero overnight. That, plus geopolitical risks and a serious lack of transparency, means you really have to be careful. So, with all these massive changes, from fracturing supply chains to the rise of AI and nearshoring 2.0, how should you actually think about all this for your own portfolio? Let's put it all together into a framework you can actually use. The sources suggest a pretty smart, top-down process of elimination. Think of it like a funnel. You start broad, with the overall market trend. Then you drill down. Which sectors are winning in this new world? We talked about the AI picks and shovels, for instance. Then, inside those sectors, which industry groups are leading the pack? And only after all that do you get to the final step, picking the individual companies that are the strongest players in the strongest groups. And no matter what you end up choosing, there's one golden rule from Benjamin Graham that's more important now than ever. Use a margin of safety. The analogy for this is just perfect. If you're building a bridge that needs to hold 40-ton trucks, you don't design it to hold exactly 40 tons. No way. You build it to hold 60 tons. That extra buffer, that's your margin of safety. In investing, it just means buying a great company at a good price, not just a good company at any price. It's what saves you when things inevitably go wrong. And this leads us to what might be a kind of brutal truth for a lot of investors. The easy money era of globalization is over. And that simple strategy of just buying a broad-based index fund, well, it's being seriously challenged now. For example, a lot of the popular emerging market ETFs are still super heavily weighted in slowing or even sanctioned regions. That just dilutes any gains you might get from the real high-growth nearshoring stars like Mexico or Poland. Buying the whole haystack might mean you totally miss the needle. This new world just requires a more active, more thoughtful approach. Which leaves us with one last really critical question. The economic battlefield has fundamentally changed. The strategies that worked so well for the last 30 years were built for a world of ever-expanding, long-distance trade. But that world is gone. So you have to take a hard look at your own strategy and ask yourself, is your portfolio built for the world we're entering, or is it still fighting the last war?